Good morning and welcome to Financial Accounting. As we look at our calendar, you can see that the first exam as well as the first part of the project were due on Sunday. If you have any issues with that, please get in touch with me right away. I'll be sending emails later today to anyone where I have a concern that something might be missing. Last week, we covered chapter 4, which was not on the exam. The chapter 4 problem then should be submitted for grading by the end of the day today. And then today we'll be covering chapter 5. So the chapter 5 pre-quiz should also be submitted for grading by the end of the day today. As always, you need a 60% or higher on that, full credit if you get 60% or higher, no credit if your score is less than 60%. You can try the questions as many times as needed to get to that 60% before you hit submit for grading. Does anyone have any questions? Anything you want to talk about? Not specific questions from the exam. I will be happy to talk with you about that next week during class if needed, or outside of class by email or by scheduling an appointment with me or dropping by office hours on Zoom or on campus in Olean to talk about anything that you have questions on, specific questions from the test. Okay. Any questions from chapter 4? Okay. Looking ahead then, 2 weeks from today, the 6-week grades are due. So we are about to start week 6. I think it officially starts tomorrow. Today, I didn't say this in class because it did not affect us, but today follows a Monday schedule. So if you have a Monday only class, it would meet today, even though it's Wednesday. And we do that so that we have, good morning, Michael. We do that so that we have equal number of Monday, Tuesday, Wednesday, Thursday, Fridays. That's 15 of each class type of class day during the semester. So if you do have any Monday only classes, they would meet today, even though it's Wednesday. So for us, it didn't matter because our class already meets on Wednesdays and Mondays. So tomorrow starts week 6 of the semester. So it ends next Wednesday. And then the following week, all of your teachers are required to submit what basically amounts to a progress report. We have to submit a grade for you. And so for this class, your grade will be whatever your grade would be if the semester were to end as of the day those grades are due. So we'll include everything up to, and they're due on the 9th. So it will include everything up to the 9th that's already been due. So I think I may have mentioned in class last week, if you have assignments that you've been working on and are done working on them and you just haven't hit the submit for grading button, please make sure you do that, because anything that does not have a submitted grade when those 6-week grades are due, I will be entering a 0 so that you have a true sense of what your grade is at that point in the semester. So please make sure that you do that. And you can tell by looking in the Blackboard gradebook. If you click on My Grades, now you will see everything that I see over here, but I don't have any grades submitted. I will be updating all of your grades today, coming over from See Now, but most of them are in, I think maybe through chapter 3. I think I did them last week. So most of your grades, other than the exam, most of your grades are already in. But if you come into the My Grades area in Blackboard and you see, oh, there's no grade for the chapter 1 exercises, you're going to want to go into See Now and make sure you hit submit for grading. You may have a 99% on that already, but if you don't submit it, I won't bring the grade over until the very end of the semester, because if you then go in and work on that again, I won't know that your grade may have changed. So make sure you hit submit for grading on all those assignments that you worked on. and are no longer covering. Of course, there's no grade for the reading assignments, so that will always be blank. If you do notice a discrepancy between what's in Blackboard and what's in CNow, please let me know. Other than a missing grade in Blackboard, that would just be something I will pick up automatically. But it certainly could happen as I'm typing in all of the grades that I make a typo. And I don't mean to do that, obviously. So if you see something that's different in CNow than what you see in Blackboard, just send me a note, let me know politely, and I will be happy to update that for you. Any questions before we get started with our new chapter today? All right, hearing none, we'll get started with chapter 5. So as I said before class started, you'll want to go into CNow and open your chapter 5 exercises. We'll get to those pretty quickly here. There's a lot of information in this PowerPoint. I'm not going to read through or talk through everything that's in the PowerPoint. As I've explained before, the intent is that you read the chapter outside of class, ideally before we are working on it in class, to give you a leg up so that you've seen the vocabulary and kind of thought about the concepts. That way we can focus in class on the doing of accounting. And there's a lot to do for this chapter. So as you've seen in the first 4 chapters, as we're doing the exercises, we also talk about the concepts behind them, but I am absolutely not intending to go through everything that's in the PowerPoint. Remember, you do have access to these PowerPoints on the Textbook Companion website, and there is a link to that in Blackboard in the Cengage content area. So you'll see a link that I believe it even is called Textbook Companion website or something very similar to that. And you have access to the student version of the PowerPoints there. So please feel free to use those as you see fit. I like the fact that they are a nice, neat summary of what's in the textbook. They should not substitute for reading the textbook, but they are a very good frame of reference for you. I just don't find it a very useful point during class for us to talk about everything that's in the PowerPoints. Although most of it probably comes up as we work through the exercises anyway. You can see on this page, you can see the learning objectives that we will be covering for the chapter. The next slide will show that there are 2 appendices to this chapter, and as we have said in earlier chapters, when there are appendices, we are not covering those in class. You're not responsible for that. It's possible there could be a question on the pre-quiz because I can't control that, but it is not on the exercises, it's not in the problem, and it's not on the next exam. So you can disregard in the textbook the appendices to this chapter. So these are the 5 learning objectives that we are going to be discussing and covering within our exercises for this chapter. So we'll be talking more about what it means to be a retail or merchandising business and looking at primarily the transactions that a retail or merchandising business would engage in. So most of our exercises are related to those merchandising businesses or retail businesses, including recording regular transactions, the adjusting process at the end of the period. So we already covered the adjusting process in chapter 3. That was actually the title of the chapter. And we'll be relating it specifically to a retail business, talking about closing entries for a retail business, what the financial statements look like. And at the very last objective, we've actually already talked about that last objective, talking about evaluating companies' operating performance, talking about the operating cycle of that company. The asset turnover ratio is something that we will cover in chapter 14. So as we've mentioned in the last chapter, I really save that financial analysis piece to the end. The final chapter of the semester where we pull everything together is financial statement analysis. So just like in the last chapter when I mentioned working capital and the current ratio, in this chapter we'll mention the asset turnover ratio and some other calculations, but we won't actually be doing those in our exercises. We will save all of that and do it together at the end of the semester. There are those two appendices, the learning objectives, but again, we're not going to be using those. Not going to be talking about those in class. You're not responsible for those. So as we mentioned in chapter 1, there are 3 basic kinds of business: service, merchandising or retail, and manufacturing. So a service organization doesn't sell a product, they're selling you a service. Like at this time of year, people might be going to a tax preparation service. A couple people in the classroom today who I noticed just got haircuts, I think since I saw you last week. And so they may have gone to a barber shop or a salon to get their hair cut. That's a service that's being sold as opposed to a product. The next step up in terms of complexity is what we're talking about most of this semester, and that's a merchandising or a retail business. I prefer not to use the term retail in this context because retail means that you are selling to the end user. A merchandising business could also sell to another seller. So a merchandising company could be like the middleman, the wholesaler, and their accounting is going to look very similar to a retail business that sells to the end user. So while this textbook tends to use the term retail business, I prefer you to think of it as anyone who is selling a product that they do not make themselves. So it could be that middleman, the wholesaler. It doesn't have to be the end, the selling to the final consumer. So that's the next level of complexity. Retail and merchandising, they're not making a product, they buy it from one entity and sell it to another entity, which could be the end user. Next semester, most of you will be taking the second semester of accounting. BUS 1520 is Principles of Managerial Accounting. It is required for all of our business degrees, just like this class is. If you haven't heard me say this already, this semester we covered chapters 1 through 14 in our book. And I know you can't see the physical book, at least most of you don't have a copy of the physical book. I may have brought it to class one time at the beginning of the semester. But the actual book is 28 chapters long. And so we cover 14 in this semester, financial accounting, that's preparing those financial statements that are required. We follow GAAP. We are preparing these for external decision makers. And then the second semester of accounting, we cover the second set of chapters, 15 through 28. And we are in that class, we are focused on mostly on manufacturing companies that are actually making the product that they sell. So most of you, being business majors, will be taking that class, and I would strongly recommend that you take it in the fall semester, just because it's easier if you don't have a big gap between the two classes. This class is a prerequisite for that class. It is a requirement that you take this class, complete this class before you take that other class. And so the assumption is you'll remember the basics from this class. Not every single thing you learn, but certainly the basics. And that would be what we have already covered up to this point. Debits and credits and the fundamental accounting equation and what financial statements look like and how to write a journal entry and how to use a T account and those kind of things are really going to be critical in the second semester. the issue is, and I've been toying with when I should mention this. So I'm just going to throw it out there today. I am retiring at the end of this semester. And so it will not be an option for you to take this class with me in the fall because I will not be here on campus. I will be, at this point, the intent is for me to be teaching an asynchronous online version of it. But if you're doing well with the synchronous, being able to come to campus or be on Zoom, I hope that doesn't cause anyone distress. Like I said, I really didn't know when I should mention that. But I think you have the right to know. So as you're looking ahead to taking that second semester, you can take it with me, but you won't be able to, at this point anyway, you won't be able to take it with me in a synchronous form like this. So I hopefully we'll be hiring someone. There's a search ongoing right now, and hopefully we'll be hiring someone, and you will have the opportunity to take it on campus here in Olean and or on Zoom, as you're doing right now for many of you. So if you have questions about that, if you want to talk about that more, feel free to ask either during class or outside of class. I'm happy to talk more about that, but it just seemed like the right time to mention it since we are talking about next semester. So as we talk about retail versus service or manufacturing companies, we've talked about the operating cycle in an earlier chapter, in last chapter actually. And so, you know, I had it drawn out on the screen for you in chapter 4. The idea of the operating cycle is starts the moment we buy the merchandise from our customers. Then at some point in the future, we buy our merchandise from our suppliers. At some point in the future, we pay our suppliers, we sell the product to our customers. If we sell on credit, then there's another lag before we collect from our customers. That whole thing is the operating cycle of our company. So our operating cycle for a retail or merchandising business looks different. A service company doesn't have much of an operating cycle because there's no buying the product from their customers. Their operating cycle is from the time they provide the service until they get paid for it. So there's a much shorter window probably. And for a manufacturing company, their operating cycle starts even earlier because their operating cycle includes the making of the product, not just purchasing it. So for companies like Siemens here in Olean, their operating cycle can be a year and a half or a couple years because they make huge multi-million-dollar compressors that don't get fabricated in one shift or even in a month or even in a year. Sometimes it's longer than that. So as we talk about a retail company, their operating cycle is probably in the middle of those two extremes. Service companies is much shorter, manufacturing companies is probably longer. With that in mind though, as we mentioned in chapter 4, the operating cycle is very much dependent on what type of company you are. So a grocery store has an operating cycle that might be just a couple weeks, where a department store like Kohl's or JCPenney has an operating cycle that might be measured in months, usually about 3 months for a department store. Any questions up to this point? Questions, anybody? So there's a picture of what that looks like in case you are a visual learner like that. You might find that helpful. I'm going to keep going here. So as we look at the financial statements, and let me jump this down to the bottom so people in the classroom can see. So as we look at this slide, and this will take us into our first exercise in chapter 5, you can see that there's also a difference in the way we prepare the financial statements. Service organization's a little simpler. Merchandising business adds an extra step, and a manufacturing company is even more complicated or complex than that. In chapter 4, we talked about classifying the balance sheet. So dividing our assets into current assets, property, plant, and equipment, and maybe some other categories. Dividing our liabilities into current and non-current, or current and long-term liabilities. And that we call that classifying it because we're giving it a little bit more detail, a little bit more information on there without actually changing the essence or the totals that are on there. What we can see in this right-hand column is a similar process for the income statement. What you see there looks a little bit different than what we started with on the income statement in chapter 1, where the generic form, the most general form is revenues minus expenses equals net income or net loss in some cases. What we have done here is add an extra step. And that extra step is right here. I'm going to add my own little, okay. So that extra step is right here, and it's an intermediate step where we take a subtotal. This textbook tends to call that gross profit. The more common term is gross margin, and I'm unclear why they use the term gross profit. We normally reserve that term for when we're talking about just one specific product or one product line, one segment of a business. But gross margin or gross profit, as this book calls it, is the revenues minus our cost of goods sold. So what did it cost us to acquire the product from our suppliers? That cost of goods sold calculation is going to carry us into the next chapter, in chapter 6, when we talk about inventories. But for right now, the only thing you need to know is that gross profit or gross margin is sales minus cost of goods sold. It's just an intermediate step in our multi-step income statement that really gives decision makers a sense of, okay, how much are they spending on the product and how much are they spending on these operating expenses, which are also referred to as period expenses. So those are expenses that happen based on the month, not based on the product that we sell. Okay, so let's go to our first exercise. It's a very short one. Come on. Why are you there? Finally. So let's go to our first exercise here. A little bigger. Determining cost of goods sold. For a recent year, Best Buy, what does that BBY mean in the parentheses there? What is that? Anyone know? Nobody knows what why they have that there? That BBY is known as their trading symbol or their ticker symbol. That is the code, if you will, for this company on the stock exchange where this stock is sold. So when you chose your company for the annual report project, one of the things I asked you to find as you posted the name, just to have you see it, it was their trading symbol. And so for Best Buy, that is their trading symbol, BBY. That's what that means. So for a recent year, Best Buy reported sales of $39,528 million. So that's $39,528 million. And its gross profit was $9,191 million. What was the amount of Best Buy's cost of goods sold? So we just went through the relationship, and I'll put it here on the screen for us again, sales minus, and this is the abbreviation for cost of goods sold. If you see that, COGS, that's the common abbreviation for cost of goods sold. I will use that because it's not just my abbreviation, it's a very common abbreviation, the accepted abbreviation, and gross profit or gross margin. So there's our formula. And so for this exercise, we are given 2 of these 3 amounts, and we're asked to find the third. Now I'm going to retain, I'm not going to put all the zeros because that's just too complicated. I'm just going to retain the label million. Now your first project was due on Sunday. And I had mentioned in class last week or the week before, one of the items that people typically tend to forget or miss on their first project is that label. So when you're asked to provide dollar amounts from your company's financial statements, I guarantee those financial statements are either in thousands or sometimes even in millions. And so if you just pull the number from the statement without including the label, you do not need to write out all the zeros. But if you don't include the 1,000 or the million or whatever the label is, your number is going to be off significantly. So sometimes it gets confusing. I think, even though I look at these numbers frequently, it gets confusing because some of the numbers are just really hard to fathom. You know, that this company, Best Buy, which is not a huge company, it's big, but it's not huge, but they have $40 billion in sales and they made $9 billion in this recent year. That's a lot. That's a lot of zeros to comprehend. Some of the companies that some of you chose are significantly larger than Best Buy, and so their financial statements might be literally in the trillions. They may have billions of dollars in cash in their company, and that's hard to wrap your mind around that. So that's why it's really important that you pay attention to what the labels are. And it'll say at the top of the report, it'll say all numbers are in thousands or in millions or whatever the appropriate label is. So again, you don't have to write out all of the zeros, but you do need to keep track of that label. And I bet every one of you heard that in math class at some point in your life. And now you're seeing where it becomes really important. So I'm just filling in the, I'm just filling in the information that's given. And so what we need here is the cost of goods sold. That's our unknown. So how do we find that? How do we find that number? Can anyone tell me what that number is? Oh, whoops. Well, and I may really need to rely on you guys because I forgot. Oh, I do have my phone. Okay. I forgot that my last class last week before the long weekend, my calculator told me it had low battery and I forgot to charge it. So, but I do have my phone. I can go back to that calculator if I need to. So what did you find for cost of goods sold? Did anyone come up with a number for that?
30,337 million.
30,337 million. That is also what I got. Thank you. And so the way you found that was you took the sales and subtracted the gross profit to find that cost of goods sold. Any questions about that first exercise? You can go ahead and click to check my work just to get your green check mark in. I told you that was a super short exercise. Everybody's good with that? So I think we'll just keep going here with the exercises. As I said, I really do not want to go through everything in the PowerPoint. Most of it we will talk about as we work our way through the exercises. There are some concepts I will need to introduce as we go along, and moving on to this second exercise, I can already see one concept that we need to cover, and that is this term right here, perpetual inventory system. There we go, perpetual. What does it mean if something's perpetual? Does anyone know?
It goes on forever.
Goes on forever, it keeps going and going and going. In the context of our inventory system, we're going to contrast that perpetual. The other option would be a periodic inventory system. And a periodic inventory system means it only gets updated, wait for it, periodically. What does that mean? Just every once in a while, right? So a perpetual inventory system is being updated continually. Every time there's a change in our inventory, we update our records. And we do not do that under a periodic inventory system. So a perpetual inventory system is very handy because at any given time, we can look at our accounting records and have a pretty good idea how much inventory we have on hand. It can help us with ordering to make sure we don't run out of stuff, but it can also help us to control our inventory that we don't have too much stuff. Inventory management is more of an art than it. There's a little bit of science in there, but it's more of an art form to make sure that you have just the right amount of inventory. Because inventory has carrying costs. I'm going to put that term on the screen also. Inventory carrying costs. It costs us money to have inventory on hand. And it goes beyond the fact that we had to buy it and pay our suppliers for it, and now it's just sitting there. There are other costs associated with that. In a very broad sense, there are costs because we have a warehouse and we have to pay for that part of our real estate, part of our property that's just housing extra stuff that we have on hand, but we're not selling right away. It's not already out on the shelves, if you want to think of it like that. We have to pay people to staff that warehouse. We have to pay taxes on the warehouse. We have to pay insurance to make sure that if something happened in the warehouse, we don't suffer a great loss. There are other potential costs as well. So maybe we buy something, let's think we're a grocery store. Maybe we buy some food and it spoils or it goes past the sell-by date. Now that's wasted. We can't sell it any longer. Maybe we are a department store and we're carrying clothing and the clothing goes out of style or the seasons change. And now what do? Do we hold on to it till next year and hope it's still in fashion next year? Or do we discount it, sell it at a much lower price than we had originally planned, than the ticket price? Another cost associated with inventory is something called shrinkage. Inventory shrinkage means that our inventory disappears, not in a magic sense, but it's gone, but we did not sell it. Well, where might it have gone? What might have happened to our inventory? We had it. We don't have it. Go ahead, Michaela, sorry.
It could have got stolen.
Could have been stolen. Yeah, unfortunately, that's the case. It could have been stolen by an employee. Could have been stolen by someone outside the company, a customer, so to speak. Yeah, that can happen. What else can happen?
A fire.
It could be destroyed somehow. Could be it's that grocery store and it just goes bad. So if you go into the produce section of a grocery store, it's not uncommon to see the racks of the day-old produce, if you want to think of it like that. So the bananas are a little browner. You might buy them to make smoothies or banana bread. Or it has the lettuce is just a little bit wilted. you know, that kind of stuff that's a little bit past its prime. And so we don't get as much money for it as we would have intended if we'd sold it when it was first day fresh. Okay. So other things that could have happened potentially, it could have been misplaced, lost, thrown out, given away as samples. So many stores will hire people, or many type companies will hire people to give out samples of their product. If you go into BJ's on a weekend, they always have little stands set up and giving away samples of their product, trying to entice people to buy it. So they may keep track of that. I don't know specifically about BJ's. I have been told that the people who do that in BJ's are not actually BJ's employees. It's an outside company that they hired to do that. But they may keep track of exactly what is used for those demonstration kind of items. But, you know, if you're in the grocery store and you say, hey, how are the grapes? And the produce manager says, well, try one to see if you like them. That's not stealing, because you were told by an employee, go ahead and try it. That's giving away a sample, but I bet money that they're not actually weighing that one grape and keeping track of that. So that also accounts for inventory shrinkage, where we bought the merchandise, we did not have it to sell. It's gone, but we didn't sell it. That actually becomes part of our cost of goods sold, because it's part of the cost of doing business. And we'll talk about that again more in the next chapter on inventory specifically. But back to this perpetual versus periodic inventory system. When we use a perpetual inventory system, we're keeping track of the transactions that affect our inventory, which would include, we buy more inventory, we add that immediately to our inventory account in our accounting records. When we sell inventory, we remove it from our inventory account in our accounting records. If someone returns, if a customer returns a product and it's still sellable, so it's not damaged or anything like that, and we're going to put it back on the shelf, so to speak, we add that back to our inventory account. That's a perpetual system. And so at any given time, if we look in our accounting records, we can see close, we hope, close to what we actually have, not taking into account that shrinkage factor. For a periodic inventory system then, we do not keep track. I'm not suggesting that we just disregard them, but we don't update our inventory account every time there's a transaction. When we buy inventory, we add it to a purchases account. When we sell inventory, we don't actually keep track of that at all. We keep track of the revenue part, but not the cost part. And so the perpetual inventory system is a better system in that it gives us more real-time information. Under both systems, there is still a requirement that we, on a regular basis, do what's known as a physical inventory. And some of you may have been involved in this at your workplace. If you work in a grocery store or some other merchandising outlet retail store, you may have seen a physical inventory take place when your auditors come in and you know, they have the little counting cards and they're marking stuff on the aisles. This has already been counted and so on. Every organization is required to do a physical inventory at least once every fiscal period, every year. But think about the grocery store example. They're probably doing a physical inventory much more frequently than that. Certainly in the produce section or the frozen foods or like that, they're doing an inventory quite regularly because they're going to have more turnover of their product. And the canned good aisle might do an inventory a little bit less frequently. Okay. Questions? Anybody at this point? Anybody questions? Okay. The next thing we need to talk about is payment terms. And right here, I can get this. Right here, we have an example of payment terms that I just put in that green box. Payment terms. You would read this 110 net 30 or 110 N 30 or 1% 10 N 30. Okay. My normal way would be the first way that I said that, 110 net 30. What does that mean? Well, I'll take the N 30 part first. N or net 30 means the whole invoice is due in 30 days. 30 days from the invoice date, you have to pay the whole invoice. But the fact that there's this 110 or 1% 10 at the beginning means that if you pay the invoice within 10 days of the invoice date, that's 10 part, within 10 days of the invoice date, you can take a 1% discount on the merchandise itself. We will get to, shortly, we will get to the concept of freight charges and who has to pay the freight, who has to pay the shipping costs. Shipping is not included in that discount. Okay, so shipping is exempt from that discount. So when we purchased, and you'll notice as we go through these exercises, we are going to be looking at purchase related transactions as we are here when we are the buyer. We'll also be looking at sales related transactions when we are the seller. So we'll be looking at both sides of those transactions. How would that be recorded? So here we are, the purchaser, and we purchased $36,000 of merchandise from Shell Company on account. So we've talked about that already starting in chapter 1. On account means we bought it on credit. We agreed to pay for it later. And now in this green box, we know later when. How do we know when that invoice is due? Well, it's based on the payment terms. We may be able to negotiate the payment terms with the seller. Depends on how much buying power, how much clout we have, how big a customer are we, how important is our business to the seller. So we may have negotiated these terms 110 net 30, or we could have, we may be the taker, if you will, that whatever they offer is what we have to go with because we don't have enough leverage with the seller. These payment terms may not include a discount at all. So it could just be net 30. And any one of the numbers in there is negotiable if you have enough purchasing power. So this has a 1% discount. There's nothing that says it can't be a 1.5 or a 2 or a 3% discount for paying early. The 10 days for the discount window, there's no reason that couldn't be 5 or 20 or any other number that's agreed upon by the buyer and the seller. And then the 30 days to pay the full amount of the invoice, again, that's negotiable. It could be 15 days, it could be 60 or 90 days or anything in between. As long as the buyer and seller agree, those terms could be anything that they agree to, anything that both parties agree to. So those are the payment terms we bought on credit. And it tells us to use, I can find it here. It tells us right here to use the net method. Use the net method. What that means is assume we're going to take the discount. Assume we are going to take the discount. In other words, assume we're going to pay within the 10 days. So we get 1% off the total. Everybody good so far? Okay. So if we're going to take the discount, how much would that discount be, or how much would we owe? We could do this calculation 2 different ways, a 1-step or 2-step way, and I'll explain both. You can use whichever one you're more comfortable with. The 2-step way would be to calculate the discount itself. So $36,000 in merchandise times 1% would be $360 for the discount. And then we would subtract that from the total to find how much we owe. That's the 2-step approach. The 1-step approach, if you're comfortable with it, if you think it's easier, is to just take the total. And if we're getting a 1% discount, that means we're going to pay 99% of the total. And again, you'll get the same you'll get the same answer. You'll get the same total, $35,640. You are welcome to do that calculation either way. You're not going to have to show me the calculations anyway, so I'm showing you both. Feel free to use whichever you find more understandable. So when we purchase $36,000 worth of merchandise on account, when we use a perpetual inventory system, we are going to add that merchandise directly to our inventory. Whoops, the number in there. Directly to our inventory account. If we used a periodic inventory system, the debited account would not be inventory because we don't update that every time we make a purchase or a sale or accept a return. If we used a periodic inventory system, we would debit the purchases, merchandise purchases account, which is not an account you would see on the balance sheet. And then we bought it on credit. So we owe Shell Company. So we would credit accounts payable. I apologize, that kind of ran into my math there. We would credit accounts payable, the liability account, to show we now owe that. In addition, you can see that it has this dash Shell Company. We don't actually have a whole separate account for accounts payable for Shell Company. Instead, we would be using what's known as a subsidiary ledger. And I'll put that word on the screen in case you're not with that term. Subsidiary, where am I going to stick this? Subsidiary. Sub means under. So a subsidiary means it comes under the accounts payable account. So we have a separate ledger under accounts payable that says how much do we owe Shell Company and when is that due? How much do we owe ABC Company and when is that due? How much do we owe XYZ Company and when is that due? Because it's not enough just to know how much we owe in total. We need to know to whom do we owe it and when do we have to pay that? When do we have to pay that invoice? And so we would enter this invoice on the subsidiary ledger for Shell Company, and the parent account or the main account, accounts payable, would be a total of all of the amounts that we owe to everybody, to all of our suppliers. Just a moment. Any questions at this point? Let's see. Oh, good. I'm glad you knew that, Damon. No problem. Thank you. Okay, any questions? Everybody good? We're on exercise 2 for chapter 5. Okay. So now fast forward, the invoice is now due. As you can see with the green arrow here, the terms were 1% 10, and we assume we're taking the discount. And so when we pay the invoice, we pay within 10 days. You know, we don't have a date here, but I'm just pointing out to you that that date we would need to pay within 10 days, or we would have to pay the full amount. Even if we pay on day 11, we would have to pay the full $36,000. Now, it may seem like $360 is not a lot to save. And so you might be thinking, well, why, whoops, let me get the right number in there, $35,640. So you might be thinking, well, why would you take the discount at all? I want you to think about this carefully. How many days are there in a year? 365. How many 10-day periods are there in 365 days? That's 36 and a half. If you can make a 1% on your money every 10 days, 36 times a year, that's a 36% return on your money, just for paying the invoice a few days, 20 days in this case, a few days early. It will always be in your best interest to pay the invoice and take the discount, almost always. Now, there may be some unique situations, but even if you don't have the money and you had to borrow it on day 10 and then pay it back on day 30 when you would have had to pay the invoice anyway, you saved 1% in those 10 days, okay? If you had to borrow the money for those 20 days, you're not paying, probably not paying 18% interest. So there are about 18 20-day periods in a year. So I'm annualizing that. You're probably not paying 18% interest on a borrowing on a line of credit that you might have for your business at the bank. It is almost always going to be in your best interest to take the discount and pay early, even if it means drawing on a line of credit for your business to do so. And so we're paying the invoice here, so we're using cash to do that. Debit to accounts payable to lower the liability, and a credit to cash to show that we're using cash to do that. Any questions about that? I'm going to erase the stuff off the screen so that I can scroll down. So we've already paid the invoice. We paid that invoice in 10 days to get the discount, the 1% discount. Now we discovered that merchandise that cost $9,000 that we bought up above was defective. And so we had to return it to Shell Company. We've already paid the invoice. If Shell Company, if we had not already paid the invoice, then Shell Company would have just given us a credit memo and we would have paid the invoice minus the $9,000. If, since we already did pay, Shell's going to give us credit. And so how we handle that credit is really going to be up to us and Shell Company. If we are a regular customer, we might just say, let it ride, apply it toward our next invoice. If this is a one-off that we bought from Shell Company, we would probably ask them to cut a check to us for the $9,000 rather than letting them hold on to our money if we didn't expect to spend that money with them again in the near future. So how do we report, or how do we record this? Well, we are going to be issued a credit memo of $9,000. This sounds really weird to debit accounts payable because right now, as far as we know, right now we don't owe Shell Company anything. And so by debiting that account in the subsidiary ledger for Shell Company, it makes, if we don't have any other payables, it would make our accounts payable have a debit balance, and that looks more like an asset, right? And in truth, it really actually is an asset for us because we now have a $9,000 credit with accounts payable. Probably we have other payables, and this is just going to net against them to reduce the total amount that we owe. But we would list it like this as a debit to accounts payable, knowing that accounts payable now for Shell Company has a debit balance that's an asset for us, so we can now spend against that later. And we're going to return the inventory to them. Whoops, what did I just do? I don't know what just happened, that my screen just got all wonky. So we're going to actually return the inventory to them. It tells us right here, and returned items. I want to distinguish between an allowance and a return. So it may be that when we inform Shell Company that the merchandise is defective, they might say, we don't really want it back. What are we going to do with it? Why would we pay the shipping to bring it back to us if it's defective and we can't sell it? So in this case, we're told that we actually returned it to them. Maybe it's something that they can now sell at a discount. Maybe it's a defect that they can fix. It just needs a new part or whatever. Maybe the packaging is just damaged and they just need to repackage it or something like that. But a return means we actually physically return the items to the seller. An allowance would be, shell company says, okay, just throw it out, would you? We don't really want it back. We don't want to incur additional expense to bring it back to us because there's nothing we can do with it. It's ruined and it's not salvageable. There's no value to it. Either way, our entry would look the same, but what we actually do with that inventory could be different.
I have a question.
Yeah.
Why wouldn't the 9,000 be discounted since they got the discount when they paid for it?
Good question. So is that 9,000? So it could be, yeah, that's a really good point. So it says invoice amount, and I was thinking that was after the discount, but you are probably right in the interpretation that that is the amount before the discount. Good call. So let's figure out how much that would be. I'm going to use the one-step method. Thank you for pointing that out. So I'm going to use the one-step method. If this was the invoice amount without the discount, then yes, they would absolutely only be refunding the amount that we actually paid, which is the 99%. So I'm using the one-step method here. Okay, so when we get down to the bottom and we hit our green check marks, we would have picked that up. Good call. Sometimes I get more involved in what else, the other things I'm talking about. Okay, does everyone understand that? Why I just changed that amount? Because the 9,000 is likely the original non-discounted amount. This is one of those situations that if we worked for the company, we would be absolutely sure. We wouldn't be speculating, what did they mean by the invoice amount? But I think that's probably true, that that is the full face value, if you will, before the discount. You want to hit your check my work and check that, you're welcome to. I don't want to get all those gray boxes blocking our page, so I'm not going to do that yet. Okay, so now we have a credit with Shell Company of $8,910. And in letter D, we're going to buy $5,000 more. The terms here, for whatever reason, are net 30. I can imagine why Shell Company would want to have it be net 30, because we already have a credit memo that's going to cover this cost, so they'd automatically be discounting it. We, as the purchaser, if we have purchasing power, might want to still argue for getting that 1% discount, because after all, they've still got our money, right? There is time value associated with money. The fact that they have our money is giving them value and not us. So in a real world situation, we might want to be, if possible, negotiating with Shell to still get the discount on this merchandise, but that's not the situation we have here. So the entry is going to look, as far as the accounts, it's going to look just the same as what we saw in letter B, or excuse me, letter A at the top, but no discount was offered. And now, as I had suggested, if we don't routinely buy from this company, we probably don't want to let them hang on to our money any longer than we need to, because then they're getting the benefit of our money and we are not. And so in letter E, we request a refund from Shell Company for the amount they still owe us. So they owed us $89.10, but we bought $5,000 more. So now they owe us only $39.10. And we're requesting a refund. Excuse me. So we are going to wipe out that credit balance, not credit, the credit that they gave us. It has a debit balance on our books. I should be careful with my language. We're going to wipe out the remaining credit that they gave us. And we are going to put that refund, the check that they issued to us, we are going to put back in our checking account, our cash account. Okay, so this is looking at, again, from the purchaser side. So we've seen how to handle, if we're using a perpetual inventory system, we add things directly to the inventory. When we buy them, we remove them directly from the inventory. When we return them or get credit for them, if we sold items, we would remove those directly from our inventory as well. And we'll see that in an upcoming exercise. Get our green check marks in there, and Michaela was exactly correct about their intent there, that 9,000 was the full amount before the discount. Okay. So we've got all the rest of the green check marks in there. Any questions on this exercise? These purchasing transactions using a perpetual inventory system. So it used to be much more common that companies used a periodic inventory system, and now it's much more common that they use a perpetual inventory system. So why is that the case? It's not so much the purchases like this, where we buy $36,000 of merchandise all at the same time. Where it becomes more labor intensive, more work in total, to use a perpetual inventory system where we're constantly updating our records, is when we're selling that merchandise, 1 or 2 items or 10 or 100 items at a time in our grocery store. If we had to do it by hand, if we had to write down, when a customer comes to our checkout station and he has 20 items, and if we had to write down and record in our accounting records all 20 items, we'd only check out 3 or 4 people in our entire shift, right? So where it is more problematic is at the selling end, when we're selling lots and lots of separate transactions. The reason more companies now use a perpetual system than did 20 years ago is because the computer software and the hardware needed to do that is much cheaper and much more prevalent. So I'll give you a quick example. In Olean, there is a Dollar Tree store, not to be mistaken with the Dollar General, where things don't actually cost $1, and that's kind of a thorn in my side. The Dollar Tree charges $1 for everything in the store. And to me, that's, you know, the dollar store, they have to charge $1. My own personal opinion. My apologies if you work at Dollar General. I'm sure it's a fine store, but things don't cost $1. So the Dollar Tree, next to Tops here in Olean, actually charges $1 for things. And so 20, 15, maybe even 10 years ago, when you went into the Dollar Tree, you got your cart if you were getting a bunch of stuff. Then you walked around the store and you just kind of put stuff in your cart, and you went up to the checkout counter, and this is how they checked out your order. You put the stuff up on the counter and they opened a bag and they just started counting 1, 2, 3, 4, 5, 10, however many. And then they punched into the cash register 10 at $1. Okay, you owe us $10, or maybe some are taxable and some aren't. They have to keep those separate. But you get the idea. They weren't recording, oh, you bought one of the 6-inch blue plates and 1 package of blue plastic silverware and a package of blue cups. They didn't keep track of that. They just rang your order up based on how many items you purchased. Now, when you go into the Dollar Tree, they scan every item. They have a little hand scanner and they find the barcode, the UPC, and they scan it, put it in the bag. And then they take the next one, they scan it, and they put it in the bag. You're all familiar with that process. From 15 years ago to now, they switched from using a periodic inventory system to a perpetual inventory system. And the reason they did that is because it became more affordable. This is my speculation. I know they did it. I'm speculating as to why. It became more affordable for the technology to put in the scanners and update their accounting records to be a perpetual inventory system. And at that point, the cost, the extra cost of using a perpetual system became worth it to them. So they had to weigh the cost benefit of using a perpetual system that's going to take a little longer and cost a little more, but it also gives us better information. It gives us information on a real-time basis to know that, hey, she just bought 4 blue plates and our inventory now shows that we're down to just 7 left. It triggers an order. We can automate some of that stuff. It can help us so that we don't run out of inventory. And at the same time, it can help us that we don't order blue plates when we don't actually need them. Because no, I know she just bought 4, but our inventory says we still have 27. We don't need to order those yet. It can help us with analyzing our inventory and determining appropriate order points, set points. When do we, when should we trigger the next order and that kind of thing. So that we, as I was talking at the beginning of class, so that we're not running out of product and losing sales, but at the same time, we don't have excessive inventory carrying costs either. Make sense? So a lot of companies 20, 30 years ago used a periodic system that have now moved over to a perpetual system, recognizing it's more labor intensive, it takes more time, it costs more money, but it's worth it to have that real-time information. As I said, both types of systems still require a physical inventory. You still have to go out and count everything on a regular basis, at least once a year. The difference is when you use a perpetual system, that count serves as verification of what we already think to be true. So we do the physical count, we compare it to what our accounting records say, and we assume, we hope it's going to be pretty close, right? And if it's not pretty close, taking into account that inventory shrinkage that we know is going to happen, if it's not pretty close, then we're going to be looking into our internal controls, something we'll talk about, you'll read about in a couple of chapters from now. We're going to want to figure out where that came from. Why did we have such inventory shrinkage this year, or this month, or whatever. If we use a periodic system, we have nothing to compare. So we do the physical inventory, we know how much we have, but we don't know how much we should have had because we haven't been keeping track of it. Okay. Questions before we move on to our next exercise? So as I said, we started with exercise 2 was a purchase related transactions. We are now going to go to the sales related transactions. We are now going to be the seller rather than the buyer. And you'll see as we move down that some of these transactions are going to involve the use of credit cards. So we will distinguish between buying on credit or selling on credit versus accepting credit cards. So when we say a credit card, we mean a bank credit card that like a Visa or MasterCard that has been issued by a bank. And so when you accept credit cards, there's a fee associated with that, usually ranges from 2 to 6% of the merchandise that you as the seller, the company that accepted the credit card has to pay that fee to the credit card companies for the privilege of accepting credit cards. That is why some companies may choose not to accept credit cards at all because they actually realize less of the sale because there's anytime you see that Visa or MasterCard logo, there's going to be a cost associated with that for that company. So as we go through these exercises, keep in mind that there is a difference between selling on credit where you owe the store who sold you the product versus selling, accepting credit cards. The seller receives that money when they sell on using a credit card, accepting a credit card. They're going to receive that money much more quickly than if you sold on store credit. Okay, so let's look at these transactions. We are going to assume in letter A that this company uses a perpetual inventory system. It does not specify, but it should have. It should say, assume they use a perpetual inventory system. And I'll explain what the difference would look like if they used a periodic system. So the first thing we're asked to record is selling merchandise for cash, a cash sale, and it asks us to record the sale first. So when we have a sale of $25,000, we increase the revenue and we increase our cash. So that's something that that transaction is something you've known how to do since chapter 2 anyway. Nothing new there. The reason I know that they want us to use a perpetual inventory system is if the company used a periodic inventory system, that is all we would need to record, because we do not keep track of the cost part of the sale. Because they ask us to keep track of that, we know that they're using a perpetual system. The cost of goods sold was $17,500. So I know the second entry is going to be a debit and credit of $17,500. But the question is, which accounts are going to be involved? Again, we've known since chapter 2, every transaction must affect at least 2 accounts, one debited, one credited. And we always list the debited account first. So, and then we indent list the credited account. So when we use a perpetual inventory system, when we sell merchandise, we have to keep track of the fact that we no longer have that merchandise. The credit would be to our inventory account. Again, that's how I know they're not using a periodic system, because in a periodic system, we don't change that inventory account during the period. We only update it once at the end of each period when we take that physical inventory and determine how much we actually have. We've already seen in the PowerPoint on the, right here, the expense account that reflects the cost of the merchandise, and it's called cost of goods sold. You can see that right here on that sample income statement, multi-step income statement. Excuse me. So when we sell inventory using a perpetual system, we immediately relieve the inventory. That is, we remove it from the inventory. We move it off the balance sheet. It's no longer an asset for us. We don't have it anymore. And we move it on to the income statement as cost of goods sold. For a perpetual inventory system, for a company that's using a perpetual inventory system, then we're keeping track, mainly, we're keeping track of our cost of goods sold as we go throughout the accounting period. There are 2 items that will affect that potentially at the end of the month when we do our adjusting entries. One is any freight costs for freight in, and I might as well talk about that right now. So we have potentially have 2 separate freight related accounts, freight in, whoops, and freight out. Okay. They're both freight related. They're both shipping charges. Freight in is the cost to get the product from our supplier to us, to get it into the store or into our warehouse. That becomes part of cost of goods sold. So any freight charges we have to pay to our supplier becomes part of cost of goods sold. And freight out, on the other hand, you can probably guess, freight out is the cost to get the product from us to our customers. And that is considered a selling expense. It's part of the operating expenses on the income statement, and it's expensed in the period in which it was incurred. So if we have freight in, it would be added to cost of goods sold in that period. If we have freight out, it shows up on the income statement as part of the selling expenses. I might as well talk about now, how do we know who has to pay the freight? Give me just a moment. Get rid of that. Oops. Get rid of that. Okay. Give me just a moment because I did not make a note. I should have. Well, maybe I don't have the picture I was looking for. Ah, there it is. Okay. So let's talk about who's responsible for paying the freight charges. We talked about payment terms at the beginning of, near the beginning of class. Now we're going to talk about freight terms. Who has to pay the freight depends on who owns the product while it's in transit. And there are three choices here. Three choices for who owns the product while it's in transit. It could be that the seller owns it. It could be that the buyer owns it. It could be that the freight company owns it. But we can eliminate one of those right off the bat. The freight company does not own the product. FedEx, UPS, any other common carrier like that, they do not own the product. They are providing a service, which is transporting the product from the seller to the buyer or wherever it's supposed to be going. They're called a common carrier. They do not own the product that's in their truck. That being said, they're responsible for it. And so if a UPS truck crashes and product is damaged in transit or whatever, I guess the truck doesn't have to crash to damage the product. If the product is damaged while it's in transit, UPS or FedEx, whoever's carrying it, is responsible for that damage. And they will have to reimburse somebody for the product. But the person, the entity that they reimburse is the owner of the product. So we're back to that question, who owns it? If it's not the freight company, the common carrier, who owns it? And the answer is it could be either one. Sometimes it's the buyer, sometimes it's the seller. This is one of those potentially negotiable things. And I think I talked about it actually last week. I think I mentioned in class that if you drive by a large manufacturing company, and I usually go to Siemens here in Olean because it's people here can relate to that. If you drive by Siemens at the end of a month or end of a quarter in particular, you're likely to see very large trucks with very large crated product tied down, tarped and so on, sitting outside their gate. And we talked about the reason why. We talked about it in the context of claiming revenues, that the revenue can be claimed when you meet those four steps. One of which is the product has to be delivered. Well, what is considered delivered? It's the point where title changes hands, where it is no longer the it's no longer the property of the seller, it is now the property of the buyer. And that point could be anywhere from when it leaves the seller to when it arrives at the buyer or some other designated point. That is called the freight terms. It determines who owns the product when title changes hands. It does not have to be physical possession of that product. And you can see here the two most common freight terms. The top one is FOB, which stands for free on board, not freight. Free on board, FOB, free on board. FOB shipping point means that when it leaves the seller, it becomes the property of the buyer. And FOB destination is the other extreme. When it arrives at the buyer, it becomes the property of the buyer. As I said, that point is negotiable and could be anywhere between those 2 points. I may have even given you the example of if a product is being shipped a great distance, where it might be going overland to a port and then going on to a container vessel and then going to some other country, it's not uncommon to have the freight terms be when it goes over the rail, when that container is loaded onto the cargo vessel, it becomes the property of the buyer. That's not uncommon at all. It could be any point in between. Why this is important right now in this chapter is the entity that owns the product is responsible for paying the freight. So while we were talking about freight in being the cost to get it to us and freight out being the cost to get it from us to our customers, we may not have to pay either one of those actually, depending on how the shipping terms, the freight terms are negotiated. Now, for most of us, we don't have any purchasing power, and so we don't get to negotiate our freight terms. If you order something, if you go on Amazon or whatever, and you order something, they're going to bill your credit card at the time that they ship it, right? Those shipping terms are FOB shipping point. You own it. You've already paid for it. You own it while it's in transit. That doesn't mean that you have to arrange the freight. Can you imagine the chaos that would ensue if every time you ordered something from an online seller, you then had to call UPS and say, I just ordered a sweater from fill in the blank. Could you go pick it up for me? Can you imagine how disastrous that would be? It would be pure chaos. So it is still the case that Amazon's going to arrange that transportation, arrange the freight for you. And I know that many of you may have Amazon Prime accounts that you don't actually pay the shipping because it's covered in that Amazon Prime. By the way, the cost is going up. I just saw an email, it's going up. It hasn't gone up in, I don't know, like 5 years, and it's going up $20 or $30 for Amazon Prime for this year. So in that case, you may not actually see a separate line item that says freight or the cost of the shipping that product to you. The shipping is covered, or it's included, or it's covered by your Prime membership. But you still own it while it's in transit, and you can tell that because your credit card has already been billed for it. Okay. Go back to our exercises. Any questions about that concept of freight terms? So we've covered payment terms, freight terms. We know that freight in is part of cost of goods sold and freight out is a selling expense. Anything you want to ask before we keep going with this exercise? All right, let's keep going then. Now we sold merchandise on account for $98,000. The cost of the goods sold was $58,800. So this is going to look very similar to our previous transactions. I'm going to ask you to complete this on your own. It'll only take you a moment. You can use what we did here in A as a model, knowing that rather than selling for cash, we sold it on credit. So go ahead and do part B on your own. You'll notice there that we were not given any information about the payment terms. So we did not record anything about a discount. But if our company sells on credit, it could be that we offer discounts and we would need to account for those as well. So just like in our last exercise, we had the purchases discount that we built in when we recorded the invoice. This company could have a sales discount, which would be the mirror image of that. Let's go to letter C. If there aren't any questions on that, part B. Letter C, sold merchandise to customers who used MasterCard and Visa, $475,000. The cost of goods sold was $280,000, and we're asked to record the sale first. So at this point, we are going to follow very similar to what we did in letter A, maybe even exactly the same, except different numbers. So we are going to treat that as if it's a cash sale, because the customer does not owe us. They owe the bank that issued their Visa or MasterCard. And the bank owes us, but we're going to get that very, very quickly from them. I don't want to put a time frame on it. I don't mean to say it's instantly deposited in our account, but close enough. And we're going to record the full amount of the sale. But when we get down to letter E, we're going to record the expense associated with accepting those credit cards. The second part, the cost of goods sold entry, is totally not dependent on whether customers bought on cash, on credit, or using a credit card. That only depends on whether we use perpetual or periodic inventory system. Now it's interesting to me that they do letter C and D separately, because from an accounting standpoint, they're really the same, whether they use MasterCard, Visa, or American Express. The difference, and this is why I think the book probably does them separately. The difference is American Express charges higher fees, and I'm going to explain why. So typically, as I mentioned, MasterCard and Visa, the typical fees that are charged are between 2 and 6%. There is no one set number. As a matter of fact, it can change from month to month. It depends on the volume of sales. So there is kind of a volume or bulk discount. If you are a larger company having more credit sales, the fees that you pay as a percentage will be lower than otherwise. American Express is not a credit card, or what we used to call a charge card back in the day. They're not a credit card in the same way that Visa and MasterCard are. Instead, American Express, if I can get my tape back up here, American Express is what's known as a T&E card. Travel and entertainment is what that stands for. And historically, traditionally, up until maybe 10, I don't know, 15, maybe 15 years ago, could be as much as 20, but no longer than that. American Express had basically one type of card, and it was the green American Express, the traditional American Express. And it was a T&E card that was primarily used by business people when they traveled. So your company would issue you a American Express that you would use to pay for your flights and your hotels and your other travel, food and stuff while you're traveling. And then the company would pay that bill or would reimburse you, and you would pay the bill directly depending on the setup the company had. The T&E card, it wasn't a credit card because the bill was paid in full every month. So if you think about a regular credit card, how do the credit card companies make money on that? Well, there's a couple different ways, main ways. One is, as we just mentioned, by charging a fee to the sellers for accepting the card. But they also make money on the card holder side by charging maybe an annual fee. Some credit cards certainly have an annual fee still. Or maybe when you don't pay your balance off in the 20-day grace period, they charge you interest. And so they're making money on both sides of that transaction, the seller and the buyer, right? But for American Express, traditionally, the green cards, for American Express, they were only making money from the seller because there was no such thing as interest on an American Express card. It was not a credit card. You didn't partially pay the balance. You were required to pay the balance every month. I'm not saying that there weren't people who maybe got hit with fees because they didn't pay on time or whatever. But in general, that wasn't the purpose of the card. And so for that reason, American Express, the fees that they charge are higher than Visa and MasterCard. And that is why many places choose, one reason maybe, why many businesses choose not to accept American Express, because it costs them more to accept American Express than it does to accept the other more common Visa and MasterCard. Make sense? So this entry in letter D is going to look, other than the dollar amount, is going to look exactly the same as what we did here in letter C and what we did in letter A. So we're going to record it as a cash sale for the full amount of the sale. And then the other side is to record the cost of the merchandise that we sold. Again, using a perpetual inventory system. And now, as we scroll down to the final part of this exercise, I just want to do some quick math here. I just want to figure out how realistic that amount is. So it says we owe $13,450. As a percent of our total credit sales, Visa, MasterCard, American Express, that's 2.5%. So I'm going to suggest that's not very realistic unless we are a super huge company. As I said, the typical range is 2 to 6%. So if we are a smaller company, we would expect to be closer to the 6%. So a cost of 2.5% is pretty low. But that's what they tell us, so that's what we're going to use. Received and paid an invoice from the National Clearinghouse Credit Company for $13,450, representing the service fee paid for processing our sales, all of our credit sales, Visa, MasterCard, and American Express. So we're going to show this as a separate line item on our income statement, credit card expense. And we're going to pay the invoice, so we're going to credit cash. So rather than reducing the total amount of our sales, this credit card expense is seen as a selling expense, and it goes in the operating expense. If I were to go back, I'd have to go way back to the beginning here. Excuse me. So if I were to go back to this income statement that we talked about toward the beginning of class today, here's our merchandising business. The cost of goods sold is the product that we sold, plus any freight in. The sales is our revenue, the amounts that we charged our customers. And the credit card expense, rather than reducing our sales, becomes part of these operating expenses. It's considered a selling expense. And so that, in case you were not aware or haven't thought this through, so that is why you see places offering incentives for you to pay cash, right? Because let's say they offer you a 1% discount if you pay cash, and if you pay by credit card, they have to pay a 2 to 6% fee. They're better off getting you to pay cash and giving you a 1% discount. They still make out better on that than if you don't pay cash and they have to pay the credit card fee. That makes sense? So that's why there are places that choose not to accept credit cards at all. That is why there are places that will incentivize you to pay cash, because they would prefer not to pay those discount or pay those fees, excuse me. The fees can be quite hefty, especially for small companies. All right, I'll get my green check marks in there. Any questions about this exercise? We're almost out of time for today. So any questions? All right, well, we'll stop there for today. Next class will be next Monday. As I said, please take a look at your exam. You should be able to review your exam at this time, the same way that you review your exercises, problems. I know you can see your grade on the exam as soon as you submit it, but since it's now past the due date, you're able to review it, and I would encourage you to do that. One way you can do that, it may not be the only way, but one way to do that is to go into the grade book and kind of click on the grade itself, and it should take you right back into the assignment. You can see all of your questions, what you answered, what the correct answer is, sometimes an explanation of that answer. And as I said, I would be happy to go over any part of that exam that you want. If there are questions that lots of people have, I'm happy to go over those during class. Otherwise, I would prefer not to use class time for that, but to have you talk with me outside of class by email, or set up a Zoom appointment, or come to my office on the Olean campus, and I'm happy to go through the entire exam with you, or whatever you would find beneficial. Especially this first exam, those chapters are so important as the foundation of everything else we do. So starting in chapter 6, what we learn in chapter 6 isn't so helpful with what we do in chapter 7 or chapter 8 and so on. But these first few chapters are the foundation, and it is incredibly important that you get this early stuff, because everything else builds on that. So please be sure you go over your exam and let me know how I can help you if you're not happy with your grade, or if there's just something, maybe you got a 92 and you want to talk about the one question you missed. That's great, that's fine too. Questions, anybody? We're out of time, so if there aren't questions, I'm going to stop the recording and we will call it a day.